Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod, two big names in business. First, from the world of banking, Wells Fargo CEO Charlie Scharf. He shares his intel on America's businesses, consumers, and economic health.
No one likes uncertainty. No one likes the idea of increased pricing, but they are hopeful that the tariffs wind up at a reasonable level. So far, that's been the case, and everyone's been able to share in that in a way which hasn't driven significant price increases. So they're looking at what the end result is, which is a more competitive set of companies in this country.
Then, from the world of sports, Fanatics CEO Michael Rubin. He's been building businesses since the late 90s, but this one outshines them all. And at a $25-ish billion valuation, it's still growing.
When we think about what gaming can be, in our 5-year plan, we have gaming being 40% of our profits.
It's another big day on Squawk Box's 30th anniversary week.
I had a better head of hair then.
You did.
We all did.
We may be on memory lane today, but the best Squawk years are still ahead.
With this withering back and forth you put up with every day, you should have a few more scars, but maybe on the
no
inside.
gray hair.
It is Wednesday, September 10th, 2025.
It's why none of us leave. We love it.
Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue it, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernen and Andrew Ross Sorkin.
Oracle shares skyrocketing after quarterly results. Shares are well above the company's intraday all-time high of about $261 a share. Earnings and revenue falling slightly short of estimates, but nobody's going to focus on that right now. AI demand is what is powering that stock higher, 30% higher. The company expecting cloud infrastructure revenue of $18 billion this year. That's a 77% increase. And Oracle signed 4 multi-billion-dollar contracts in the latest quarter, including with OpenAI and Google. Here's the company's CEO on the earnings call speaking about the cloud business and its RPO, which is its backlog.
It was an excellent quarter, and demand for Oracle Cloud infrastructure continues to build. I expect we will sign additional multi-billion-dollar customers, and that RPO will likely grow to exceed $500 billion. The enormity of this RPO growth enables us to make a large upward revision to the cloud infrastructure portion of our financial plan.
And Oracle Chairman Larry Ellison also speaking on the call. Here's what he had to say about AI.
It's AI inferencing that will change everything. Oracle is aggressively pursuing the AI, and we're not doing badly in the AI training market, by the way, but inferencing's bigger. Oracle is aggressively pursuing the inferencing market as well as the AI training market.
And with this morning's jump in Oracle shares, Ellison's stake in the company now worth about $350 billion. If that gain holds through today, his net worth would increase by more than $70 billion. And according to the Bloomberg Billionaires Index, the previous single-day record for an increased net worth was $36 billion. That was for Elon Musk last April, when Tesla shares gained more than 22% in a day. This gain would smash that record.
And I think we're up near 800 billion now for the market cap for Oracle.
882.
Yep.
Yeah, closing in on, I did it quickly.
Well, I'm just looking at it. It's behind you on the screen. It's behind you on the screen.
To 312.
882 with these gains, if you count it.
So he owns a lot, still owns obviously a lot of the company.
The other thing I think that he said on the conference call that was so important is that AI is so important. Oracle, he said, doesn't generally deal with CEOs, but now they're dealing with CEOs regularly and even heads of state because this is such an important play. And man, they are ramping up fast.
And they'll own TikTok sooner or later, too.
Safra Catz also said that they're not investment light, the way Wall Street says, but they're investment sort of light because they're spending their money on a lot of equipment, but not on land, not on buildings like some of their competitors.
If you ask, probably, if you did a poll now, probably 50% of these crazy people on the left would say that billionaires are bad for society. And I don't understand it. It's not. And it's the old thing where Bono said, and maybe over in Ireland, you point at the hill and say, I'm going to get that guy over here in the United States. Say, I want to be that guy. Right. It's not a zero-sum game. Think of all the employees think of all the shareholders and how they've been enriched. Think of all the tax revenue that comes. Think of all the way that it is revolutionized
the backdrop of what's happening
software.
With the mayoral race in this town, and wonder again.
Is there another way to do it?
Wonder if that's the case. Wonder if there are people saying, "Yeah, we want to."
But is there another way to do it? Is there something? Is there
system?
something that we should cap about if he's the owner of all these Oracle shares because he's the founder and this, the guy that's responsible for everything? Should there not? And his stake goes to $350 billion. Is there something the government should do to prevent that from happening over and over again? Or should there something the government be doing to help it happen again and again and again?
Okay, now we're going to go to a very philosophical question.
No, we're not. I wanted you to just say no. I didn't want you to. I don't want you to say anything about it.
I know where he's going to go. Because there's a valid question around what you do with the taxation around that, right?
Oh, I wasn't even going to go there, but
that's a good place. That's an okay place to go because if he never sells it, then he never.
I think there is a big taxation question, which is
on the capital gains, which will never be realized.
Capital gains, which is never going to be realized, and then therefore whether other Americans, the workers, effectively subsidize that wealth creation. So that is actually a real question. I was actually going to go somewhere else, which is...
I'm worried.
You had said, that do people want to be billionaires? I think people want to be billionaires. They just don't want to be known as billionaires. And that's actually a very interesting thing.
Is
why
bad.
Is that?
That's what I mean.
But I was going to say...
I think it comes from what happened with Occupy Wall Street.
But it's not just that. I think it's people don't like conspicuous consumption. I think it's the same reason.
They aren't necessarily. Some of them are. He's got a pretty nice boat.
I was going to say it's
not a boat. It's a ship.
the same reason why I think actually people admire Warren Buffett as much as they do.
Right.
Because he's somebody who still lives in the same home that he did in the beginning. He carries a green American Express card, not the platinum card. And there's a reason for that because he's not trying to suggest to the world that somehow he has more or he is better than others. I actually think that's a huge part of what is going on here with this sort of idea of billionaires. By the way, I think the capitalistic system is the system.
But
I'm just saying
that's a fair point. Conspicuous consumption.
I think there's something to this idea about why people get, and this is about inequality and why people get upset about it and this and that. Beyond, like, should you want to be? Yes, it would be great for everybody to be a billionaire, right? But everybody can't be a billionaire. But then it's also a question of what do you do with that money? How do you act with that money?
With great power comes great responsibility.
Exactly.
With great money comes great responsibility. Right. I think too. It's take it all back to Spider-Man.
It's like all or nothing, though. Either you decide, look, you don't. If a guy has $350 billion, you really don't need it. The 349 could be used for something else. You could make that argument. You take your billion and live great for the rest of your life. We're going to use the 349 to do all this stuff for people that are. That's one way to go.
But then you take away
the other way is
and that's why performing more.
Elizabeth Warren can say that again and again and again, and no one's going to. I mean, on the face of it, it sounds normal. 3%, 3 cents on every dollar.
But the problem is if you start putting those restrictions in place, it takes away the incentive for people to perform at their highest levels in terms of capitalism.
I think Larry Ellison's been a great thing for society and everything that he's built, and I think it's been a positive. I don't understand.
Are there people out there who are saying otherwise?
About him? Not about him in particular, about billionaires. About billionaires. Really, they hate billionaires. They want to get rid of billionaires. They're sick of billionaires. They don't want billionaires. They think billionaires are horrible. Maybe if you inherit it, it's not quite as good. A federal judge blocking President Trump from removing Lisa Cook from the Federal Reserve Board of Governors pending a legal challenge. The judge granted Cook's request for a temporary court order to keep her seat. While she challenges her firing, the judge said her case is substantially likely to succeed because her termination didn't comply with the requirement that Fed officials can only be removed for cause. We talked all about this, in fact, with FHFA, with Bill Pulte. I guess it was last week. President Trump had cited unproven, at this point, allegations of mortgage fraud in firing her. She needs her day in court. The Justice Department has since opened a criminal investigation, according to the Wall Street Journal. Big IPO, online lender Klarna, pricing its IPO at $40 a share. That's above the expected range. I think it was 37 to 39. Deal values the Swedish fintech buy now, pay later company at $15 billion. raised close to $1.4 billion in the IPO. The stock is expected to begin trading today on the big board under the ticker symbols KLAR. It was originally aiming to go public earlier this year. Plans were put on hold after President Trump's tariff announcement rattled financial markets, but they've wanted to go public since 2021, at least. The company was worth, it's $15 billion now, market cap. It was $45 billion during the pandemic, $45 billion. And the revenues are higher now than during the pandemic, but the higher interest rates, everything else hurt valuation. But Sorkin, you're getting your wish. You're getting your wish.
My wish.
IPOs are hot. M&A is hot.
He's wasting his wishes on that.
Things are happening. Things are happening. They're percolating. The
IPO. The window is now open.
The window is now open.
The window is now open. So a little bit of animal spirits. That's a good thing.
Is that just a reflection of where the major averages are? I mean, when you're closing at new highs every day, it feels like a good time to kind of get out there.
Typically, I mean, it's interesting. In an IPO, you want to go out when things are good.
Yeah.
In merger land, the truth is people do their mergers when they have the most confidence, which is usually the worst time to do it, right? When everything's going terribly, nobody wants to do a deal because they think they have to fix up their own house first. The problem is that most people do deals at the top of the market.
Right, you get a good price when things are questioned.
So it's above the range. Is it going to be one of these? I mean, it doesn't sound that sexy to me. It's like a firm, isn't it? But is it going to be priced at 40 and open at 70?
I don't know, but go back.
Is it going to be 70?
I don't know, but go back and look at
see where it
Figma.
is in 6 months.
Figma went nuts.
Went nuts, but then didn't.
Back.
So maybe that will be in people's minds.
Right.
Coming up next on Squawk Pod, how America is doing economically. Our next guest knows the consumer, small, medium, and large businesses. Plus, he's in on artificial intelligence, too. Banking is big. Wells Fargo CEO Charlie Scharf.
The market has certainly up till now gotten wrong what the impact of tariffs will be, both on prices in general, but also what the impact on markets are. And I think, there was a view, certainly early on around Liberation Day, of just the extreme impact that tariffs at that levels could have. And what you found is that the ultimate levels are more moderate than that.
This is Squawk Pod, where we are celebrating 30 years of Squawk Box on CNBC and the 14-year-strong anchor team of Joe Kernen, Becky Quick, and Andrew Ross Sorkin. In fact, we rendered them speechless yesterday.
They're already grown up by then.
My goodness gracious.
You guys came in. How'd you get up from...
With a surprise visit from the families of all three right on set.
You probably know by now. We are marking the 30th anniversary of Squawk Box this week. We haven't talked about yesterday. I watched it, having been here and then having watched it. It was two different things from because it couldn't be necessarily shot right. I thought they were going to show a lot of video of my kids and growing up. So when I was introing it, I was looking and expected to see Blake and Scott and whatever when they were like little kids. But it looked like I was just introing them that they were here. When I looked at the video that they showed, I thought, why are they starting with this later video that had been shot? I thought I'm like, wow, where is that from? And it wasn't until Blake touched my back and I turned around and saw her. I didn't realize that, and then you, I think, looked over and were like, your kids are here. And I was talking about my family, and it's like, well, I would have invited my kids.
Okay, this is this.
Becky's going to cry. I'm not going to cry. That's right.
Wow.
If I look at this.
Then next thing you know, Pilar and your kids walked in. But the way it happened, none of us, for 2.5 months, they kept this secret, and that's what brought the tears. If I was talking about the family, and it looked like I was just bringing them on,
right.
And why would I be surprising?
Us.
Yeah,
they did a great job of surprising us.
They did.
Okay, the real question is, what are you going to do with those big heads, what they call the fat heads?
Oh,
you heard Penelope. I said, I don't know why we're crying, and she goes, look at this, and you'll know why we're that big head. It's too big, and it's too. The gap in the teeth is like this wide on the big. It's too big. Anyway,
You can auction them off to the highest bidder, but then you don't know what they'll do with them. which could be
train puppies, maybe. Put it on the newspaper.
That-
Here is
I can think of worse.
Dartboard.
Yeah, that's not worse than the puppy taking a. Anyway, here's a moment from the summer of 2000. We're going to go through some vignettes. This was 2011.
Good morning and welcome to Squawk Box here on CNBC. I'm Joe Kernen along with our newest Squawk anchor. I'm happy to welcome and officially introduce Andrew Ross Sorkin.
Do we get to go crazy all at one time? No, I think we're going to be okay. Can I take the jacket off?
Oh gosh, there's something very
Is this okay? I'm a little nervous about doing this.
Action, Carl. I'm sitting in your seat. I don't even know what to say about this.
It's
Melissa
your seat now.
That is hilarious.
Haynes gave everyone.
I had a better head of hair then.
You did. Haynes gave everyone a
Well
nickname. I mean, I was Kahuna in the Brain, obviously, and the Church of Reverend Jim Bob Kramer. And I had one for you, and you were having none of it. But do you remember what it was?
Raw.
Because my son thought his name was Andrew Ross Sorkin.
Oh, Raw.
Right. And I was a wrestler.
I was doing a wrestler.
That's pretty cool, actually.
It's Andrew Ross Sorkin. He's too big to fail. And we were going to do that. Intro you, use your book title, use it all
great.
in there and have.
And I was trying to be serious. I
know. Those were the days you were trying to be serious. You've learned.
I was so young. All I wanted to do was be taken seriously. Now I'm not taken seriously.
It's too late.
It's too late.
Let me.
Actually, your hair's not that different.
You know what? You're doing well.
Yeah.
I'm holding up.
You are
I'm holding up.
With this withering back and forth you put up with that every day. You should have a few more scars. But maybe
You have
on the
no
inside.
gray hair.
There are some grays in
Maybe
there.
you're a mess
There are
on
some
the
grays.
inside.
It's
Yeah.
getting a little thinner. There's a lot of that. We don't need to get into all of it.
You know what?
It's true.
I can take care of those grays for you.
Yeah, his Grecian formula.
No, I'm kidding. I do not. Why do I do that? I constantly. No, amazing. You haven't. I'm worried about the insides. If you look that good on Dorian Gray up in the attic.
Right. Oh, could be. No. Yeah. You could just fall apart later. Exactly.
You're brittle.
For a look at the economy, the consumer, the Fed, and so much more, we can go a million places this morning. Joining us in an exclusive interview is Wells Fargo CEO Charlie Scharf, and we're thrilled to have you at the table on this 30th anniversary week of Squawk Box, no less.
Great to be here, and congratulations to you. 30 years of anything's an accomplishment these days.
Thank you. So the big question is the state of the economy. Yeah. Your colleague, former colleague, Jamie Dimon, says the economy is weakening. Do you believe the economy is weakening?
You know, first of all, I think it's complicated, and I think sound bites are awfully difficult to take out of context. And I put it into two categories. Number one is what we see in our own data. The second is what you see more broadly. In our own data, things are remarkably stable. I mean, we look at, I know you guys have talked about it this morning and other times, consumer spend continues at the same year-over-year pace across almost all wealth levels. Consumer credit is as good as it's been in the last 6 months. In fact, it's probably trending a touch better. Companies are in really great shape. We look at signs for any kind of change, and you just don't see it. Having said that, there is this big dichotomy between higher income and lower income consumers, which continues and is a real issue. And when you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So, yeah, things are actually feel very good today, certainly relative to what you think they could be. But it's not equal across wealth spectrums, and there's probably more downside than upside at this point.
So the high-end, low-end consumer spending, you see it, but it's the same as it was a year. It hasn't gotten any worse.
Yeah,
is that
it's interesting what we see is we see fairly consistent spending levels across low end and high end, except the low end is spending the money that they have. So their balances are below where they were pre-pandemic levels. But they are living on the edge. Hasn't impacted credit yet, but they're certainly not becoming more healthy, and the affluent customers are bringing up the averages.
Here's the weird thing. If consumers are still spending and businesses are still printing record earnings, stock markets at new highs, you would think businesses would be more inclined to hire people.
Right.
Why do you have the jobs picture looking as weak as it is when businesses, you would think, would be feeling pretty good about things.
Yeah. Well, listen, it's hard to exactly know. What I would say, we spend a lot of time talking to our middle market customers across the country. And I think certainly tariffs do have an impact on it, which is that, well, and back up. It's actually very interesting. When you go around the country and you talk to middle market customers, it doesn't matter whether you're in a red state or a blue state, what you hear is more business owners and people leading these mid-sized businesses happy that this country is dealing with the trade inequities that have existed. So they feel good about that. They're willing to deal with the uncertainty, but they need to react to that. And so part of that is just being very prudent in how they're hiring. And so, that certainly seems to, be dampening, the increase in jobs. And then beyond that, there's the whole AI revolution. I personally think we're still so early in the impact of AI that it's hard to actually believe that that's the meaningful driver today.
Right.
But it certainly will be.
When you've thought about job count, employment, have you gotten to a point where you said the AI is so good that we can actually scale back in terms of new hires, for example? Are you there yet?
We're just starting to get there. I mean, you're starting to see it in those places where it's easiest and most obvious. Within technology, in terms of coding, I mean, the efficiencies you can get by using the tools today are significant, and you can either get a lot more productivity and have the same number of people, or you can deal with less people. We're growing our tech budget, so for us, it's less about having reduced headcount in technology, and more about just being able to get more done.
In terms of the credit score, if you will, of America, when you look at just how people are either taking on debt or not, in regards not just to mortgages, I'm talking about credit cards and the like, how much of that is a feature of what's happening in our economy?
Well, it looks like when you look at what's happened in the credit spectrum, that the financial institutions have been fairly prudent about not allowing people to overextend. So when you look at our credit card growth, we've grown substantially over the last 4 or 5 years with new products and whatnot, gone from 35 billion to 50 billion receivables. That number has actually kind of leveled out over the last couple of quarters, partially because we've tried to be very prudent about who we extend credit to, but also because payment rates are very high. So, certainly the credit segment where we participate, I think, financial institutions have been quite constructive.
So you don't believe that people are sort of overextended in some other way that we don't know about? You've read, over the summer, there were a bunch of these articles about how maybe parts of the country were
you just don't see it in the
living
results.
Beyond their means.
You just don't see it. Again, when we look at, early stage delinquencies across all the different folks that we lend to, it looks good.
By the way, as a bank, how do we have this Klarna IPO coming up? Mm-hmm. How do you think about the sort of buy now, pay later, and all of the sort of fintech companies that have come on that effectively are trying to compete away some of the more classic legacy businesses?
Yeah, listen, it's competition. It's competition in lending. There's competition in the deposit space. Our view in terms of what we do and the benefits that we bring is it's a broad relationship. So it's not just about the credit card loan. It's not just about the mortgage. It's about all the things that we do, and I think that's one of the huge benefits that a substantial institution like ours brings, is we can provide a broad set of advice and help you both on the deposit side, the loan side, investments, and all the other things that you need.
The people who are naysayers and concerned about some of those fintech companies would say, hey, they don't know how to price loans appropriately. Do you share those concerns, or do you think
listen, I would say the following. I think when you look at consumer markets and when you look at wholesale markets, there's a huge amount of liquidity available for loans, right? And whether it's in the public space, the private space, not everyone has been through a cycle. And I just think that, yes, some people understand it better than others. I don't know who really understands and who doesn't, but there will be casualties for sure.
When there's a
cycle, which there will be a cycle. Pretending that there won't be a cycle is just crazy.
Charlie, there's criticism of the Fed paying banks to hold reserves instead of lending it out, and I've seen numbers how it adds into to big banks, to the profits. Is that a real profit generator for you?
No.
Would it be? It's
not a real profit generator.
And would demand? Is there? Is there not enough supply to meet the demand for loans because you want to keep it in there and keep earning a nice interest rate on it? Does that actually happen? Or?
Listen, we want to lend.
You want to lend.
That's what we do. It's not just about how much money we make. It's about when you lend to someone, it allows us to have a broader relationship and provide advice and treasury services and things like that. So
it's a much more profitable relationship.
Yeah, that's the business. It's not. We're not.
What is that, a red herring that you hear? Just another way to complain about the Fed? Or?
Well, I think there's a question about, when you have this excess cash, which we have to keep for a bunch of reasons, people, deciding what we should get paid on that. But listen, first and foremost, we want to be able to lend as much as possible. And given the situation that we're in now, it's a really exciting time for us because we can lend in ways that we were restricted when we had the restrictions prior to June.
Mm-hmm.
You've seen Ken Griffin has been critical of the Fed. Most CEOs in America have not been, not critical of the Fed, critical of the president about undermining what he would argue is the independence of the Fed. Where do you stand yourself on the independence of the Fed issue?
Listen, I absolutely support the independence of the Fed. The Fed has to be independent. And the Fed is independent. The fact is, these terms are not coterminous with those of elected officials for a reason. And so, every president who appoints someone in any role, whether it's a Fed or not, takes a lot of things into account, including, in this case, views on interest rates. So that's not something new. We just, differentiate, there's a big difference between the president having an opinion on interest rates and believing that changes the level of independence of the Fed, right? We've got senators, we've got everyone from progressive senators having a view on what the Fed should do all the way to the president. And that's not new. This president happens to be very vocal about it.
So but that sounds like you don't think it's that big a problem for the president to be this vocal about it. On a relative basis,
I think the administration is entitled to be vocal about it, and I think the Fed should do what it believes it should do based upon the information that it sees.
Charlie, the market has, it closed at new highs again yesterday. Mm-hmm. Your stock has outperformed the market. I think it's up more than 15% year to date versus around 10% for the S&P 500. But your stock dropped in April just like everybody else's did. I think it was trading down at around $60 versus above $80 today. That was all around concerns around tariffs in April. Was that just a big head fake? Was that far too much concern that the market put into it? Or do you think the market is misreading the potential disruption for tariffs at this point?
Well, I think you got a couple of different things going on. The market, first of all, the volatility in the markets is extreme.
Yeah.
And a lot of it relates to who's owning stocks, why people are involved in these things, and the amount of information that just flows. And I think, listen, the market has certainly up till now gotten wrong what the impact of tariffs will be, both on prices in general, but also what the impact on markets are. And I think, there was a view, certainly early on around Liberation Day, of just the extreme impact that tariffs that levels could have. And what you found is that the ultimate levels are more moderate than that businesses have been able to plan, have been preparing in many, many ways, and the impact ultimately on consumers will be far less. So therefore, the economic environment and the environment for banks is very different than people initially thought it could play itself out. And so again, we sit here today, it's a pretty good environment for us, right? Markets are open, there's an incredible amount of liquidity, consumers are strong, businesses are strong. And yeah, there are these questions that remain about employment and about what levels of pricing will be. But one thing that we do have overall is we have an administration which is a pro-growth administration. And so, that as balancing all of these other things out there, I think is part of what you're seeing in terms of where the market's reacting.
We talked about AI earlier, but I'm actually curious whether you think that the broader economy is being lifted by this AI boom. How much of the economy, and is that a pocket? Is that a gold rush, a sugar rush? What is that? You're on the board of Microsoft, so you have a pretty good insight into the idea of how much big tech is going to continue to spend and what kind of pace that will look like over the next 5 years.
Yeah, like I said before, I think it's very early on. So I think in terms of what you're actually seeing in the ability of companies to get to use AI to become more efficient and to drive more value, it's very, very early on. Everyone's focused on it, everyone's spending, but people are figuring out you're just starting to see the impact. So I do think it's going to be meaningful. I think instead what you're seeing just normal kicking around. There are risks out there. People are thinking about employment, they're thinking about inflation, and we need to get smarter about how we run our business. We've got to control inventories, we've got to control headcount, and I think that is today's primary driver. But we do have this big benefit coming in terms of what the whole AI revolution means.
You don't look at this and think that this is like fiber in 1998 or 99 in terms of these data centers and how much, because there's sort of a massive trickle down effect, which is great in this moment. The question is that a sustainable scenario?
Listen, what I think is that the use cases for the AI tools that now exist are huge. And even in our own company, there's almost nothing that we do that we shouldn't be able to do differently because of AI. It could be credit memos, it could be advice for customers, it could be a huge number of things. And it takes a huge amount of information and data to get that right. And where we are in terms of developing models, we're not at the end of that.
You said something.
I don't see the end in sight yet.
I'm still thinking about it. You said in both red and blue states, plenty of corporations, medium, small, big, are saying we are okay with trying to correct the trade imbalances that have built up over the years. So we're not entirely opposed to tariffs. We just need to find a way to deal with them. Is that really what you said?
I was surprised. I mean, I think when.
Well, I'm surprised that you said it. We never hear that, or at least we wouldn't want that word getting out. So some people are saying.
I travel the country almost every week. I'm going to be in Phoenix later today. I'm having a dinner with commercial banking clients. And again, what they say is that there's a reality that trade has been unfair, that people can come in and compete in this market in a way where they're subsidized by foreign governments. We can't offer our products on a similar basis outside the country. And many are happy that we're willing to take that on. No one likes uncertainty. No one likes the idea of increased pricing. But they are hopeful that the tariffs wind up at a reasonable level. So far, that's been the case, and everyone's been able to share in that in a way which hasn't driven significant price increases. So they're looking at what the end result is, which is a more competitive set of companies in this country, which we support because we're such a big American company. That's who we are.
I would we never would, but I would put that out on CNBC.com or at Squawk.com, but don't wait for that anytime soon. Thank you.
Charlie Scharf.
May have just made it happen.
Tease will be next.
Coming up on Squawk Pod, a longtime guest of the show, from many eras of e-commerce to the multi-billion-dollar sports company Fanatics, Michael Rubin.
If we had asked you in 1999 whether there'd be sports gambling in America, whether you would be one of the sort of leaders trying to make a real way in that space, would have you believed it?
Yeah, absolutely. I'm honestly surprised how long it took.
We'll be right back. You're listening to Squawk Pod during our 30th anniversary week with Joe Kernen, Becky Quick, and Andrew Ross Sorkin.
Squawkbox, and some of the folks that actually make the magic happen every day. This is the control room back in Eaglewood Cliffs. Guys, turn around for a minute. Lots of our friends and family who are here.
The responsible parties.
Greg Lord, Paul DeFabio, our director, Matt Greco, Terry King, Octavius Williams, Dave Evans, Dan Mescon, Rob Contino, Patrick Brooks, George Meneses, and John LaFont's not in this control room. He sits over on the side, but he's our audio guy who has been with us for almost all of the last 30 years. Took a brief hiatus, and then we lured him back. Oh, right there.
There he is.
I just saw him. Turn around, guys. Look at the camera. Look this way. Mwah.
Joining us right now is another guest who's been coming on Squawk Box since the late 90s. I hope we have some video of this, Michael. Michael Rubin, CEO of Fanatics, is here. We got a lot to talk about what's going on today. But we went back, I think, at like 99.
I'm just happy I don't see any videos right now because I would have been like pudgy, less hair, a really awkward suit. So thank God there's no footage.
Not yet. Not yet. I don't know where the producers are with the footage.
Wait, less hair? You have more hair?
I get a little bit of hair from the back of my head to the front of my head. It's like you got to stay younger.
And you copped it. That's cool.
Yeah, of course. Good. I'm always very transparent.
You look great.
And look, we have incriminating videos about you, of course.
I know.
I do want to congratulate you after your comeback at Fanatics Fest this year. Where you actually did catch a pass from Brady when he underhand threw it to you because he Want to give you like a, I want
with
this
a bunch
guy
of like pine tar, like it's
We
sticky.
do what we got to do, all of us, both of us.
Okay, so here's the question. If we had asked you in 1999 whether there'd be sports gambling in America, whether you would be one of the sort of leaders trying to make a real way in that space, would have you believed it?
Yeah, absolutely. I think you have to look at the rest of the world, and I think sports gambling's been a big business in so many geographies throughout the world for such a long period of time, and I think it was only natural that a market that was big and vibrant but illegal here would migrate to a much legal and safer approach. So I think I'm honestly surprised how long it took. And so in the late 90s, you could have looked in England or Germany or France or any of these other markets that were fully regulated, had big businesses, and said, this has to make sense, it's got to come to the U.S.
When you think about the valuation of your business, the whole Fanatics business, what does the sports book represent to you?
Yeah, I think it represents a pretty meaningful part of our growth. I'll tell you, I just realized when I walked in here today, it's a 2-year anniversary from when we started taking bets. And we're now the 3rd largest player in the sports market in the U.S. We're the fastest growing sports book in the U.S. And it's really because we have a better value proposition and it's working. Last night I went to a friend's tequila launch, and 2 different people came up to me and said, hey, thanks for what you did with creating fair play. Fair play is a policy where if your player gets injured in the first, it used to be the first quarter, now it's the first half of the game, we take them out of the player prop. And so hundreds of thousands of bets that would have lost, people actually won as a result of that. Right. By the way, we had one last week where it cost us $1.5 million, but it's the right thing to do to kind of give that insurance.
And nobody else does that?
Now competitors are copying us. By the way, DraftKings, Jason's a good friend of mine,
Yeah.
they copied us. Okay, other companies are copying us.
You guys are the fastest growing. Where are you? That's because you started from zero base.
Started from zero.
Where are you just in terms of like raw numbers? How soon before you
3, right?
Yeah, we're number 3, but we have about 8. Look, FanDuel, DraftKings, absolute leaders. They've built incredible businesses. They're both really well run, and they each have about 35% of the market. Okay. We have 8% of the market, but we had 4% a year ago and 0 the year before. So we're definitely the fastest growing.
Are you taking from either of them?
I think we're taking from everybody. Look, they have great businesses. I think some of the small competitors have been easier to take from. But we went out and said, how do we make this better for sports bettors? And just our value prop, we had a lot of thought went into this. How do we do something that's different and better? And so instead of spending money in advertising, let's give it.
That's what I was going to say. The customer acquisition costs have always been like this big killer, but you think you can acquire more customers without spending
our
marketing?
Customer acquisition cost is definitely less than a DraftKings or FanDuel. And the reason is every time you bet with Fanatics, whether you win or lose, we give you fan cash that you can then make other bets with. You can get merchandise, you can get trading cards.
That's what I was going to say. Tying it all together, do you find those synergies make it a much stickier place? How do you play with that? How do you use that?
Much stickier, resonating really well. Look, we're going to give out $1 billion of fan cash next year to bettors,
okay, that they're used to get merchandise. Do you count that as customer acquisition cost when you do that?
I think we run a little bit of a lower margin, but I think we can make it up in volume and doing the right thing.
So your customer acquisition cost is lower, but you're spending that money in other ways and other places.
Absolutely. Our customer acquisition cost is lower for sure, okay, than a FanDuel or DraftKings. And we also have a lot of brand marketing for Fanatics that we have from the commerce business, from the collectibles business. And so I think when we have 120 million customers, and more than 50% of those customers, they know about the sportsbook. A lot of those customers use the sportsbook.
I used some of your fan cash the other on Monday night, and I won, but it's rare because what you have to do is when you have normal a balance, you bet $10, and you get the 10 back, and you make $30. When you do fan cash, all you get are your winnings. So most of the time you don't win, so the fan cash is not, it goes away.
But it was a genius invention by Matt King, the CEO of our gaming business, who used to run FanDuel before he came to us. And he really came and said, look, I want to make this better for customers. What do we do different? He said, we're going to do 2 things. Number 1, every time someone makes a bet with us, we're going to give them fan cash. That's $1 billion we're going to give out next year they can use for merchandise, for tickets, to make more bets, to buy collectibles. That's really resonating well. Again, win or lose, you get the fan cash. Number 2, this fair play, which is kind of like this free insurance, and that value prop is what's resonated so well. So that's really driven the growth of our gaming business.
Do you see long-term there's going to be more consolidation, though, in this space? Because the weirdest part about this business is you would think, they always say the house wins, and therefore it should be this massively profitable, crazy, over-the-top industry that just prints cash. And I think part of it is the acquisition cost, part of it is the competition. Most of these businesses have not been like wildly excessively profitable yet.
Yeah, so I'd say outside of the U.S., they are wildly profitable.
Yes.
And I think in the U.S., they're becoming wildly profitable right in front of our eyes. So if you look at DraftKings, 2 years ago, they were losing $500 million or $1 billion, maybe 3 years ago. This year, they're going to make $900 million. I think FanDuel is going to make $1.25 billion this year. So these companies have very quickly swung from tough businesses to very good businesses. And what happened was, I think, in an environment when the market was a little bit ridiculous. And by the way, Wall Street had a part to play in, they had a real role in this. They were giving free money away, so people spent illogically on customer acquisition. When we got into the business in 2021, what I said to my board was, look, I love this business long-term for Fanatics, but I don't think the economics currently make sense. Let's bring Matt on. Let's evaluate the market. It took us 2 years to launch, and by the time we launched, everything was more logical, and today it's the most logical it's ever been. So I'd say we're in a much more thoughtful market today, but the market is still just getting going.
In terms of what you are going to spend that may cut into your margins to do things to win fan loyalty, to bring them back, is that a constant, or is there a point where you can ease up on some of that? Because the thought with the customer acquisition cost is it would eventually go down. You would have people, you would buy loyalty, but it's a really tough competitive market.
Sure. So the way to think about that is hold rate. How much do you keep from a customer? And I think if you look at a Flutter or a FanDuel, they could hold in the U.S., 13 or 14%. At DraftKings might hold 12%. Today we're at 10%. Maybe structurally we're always 100 basis points or 200 basis points lower. That's still a great business for us. And when you take the synergy of the Fanatics ecosystem and what it means to collectibles and what it means to the commerce business and how these things all integrate together, it's a incredibly big opportunity for us. When we look, you asked about the value of the business. When we think about what gaming can be, in our 5-year plan, we have gaming being 40% of our profits.
Really?
Okay. So, and we're very bullish about that.
And where is it now?
Yeah, I mean, today we've spent $1.5 billion since we've launched, including
so it's not profitable,
including the M&A deal we did. No, we'll lose about $300 million this year. We'll lose about $150 next year, and then we'll make several $100 million in 27. We feel great about that because if you look at what did Flutter and FanDuel spend between the M&A, same way we look at it, they spent $6 to $7 billion. Same for DraftKings. So we look at a less than $2 billion spend to get to profitability versus these guys having a $6 or $7 billion spend. Again, they built great businesses, but they spent a lot more to do it.
Michael, we might be in an open window for IPOs. Do you even look at this moment at all and say, I want to use this window?
I don't. We don't really get excited about market changes. We think about how do we build the best business. What I'm really excited about is look what's going on in our collectibles business. I mean, we are driving the entire collectibles industry. That business, we won all the rights in 2021. In January 1st, 2022, we bought Topps. It was a $500 million business. It'll be more than a $3 billion business.
Yeah, and I have to say, watching what you've done with that has been really, really impressive. As somebody who's got a kid who collects all of these cards, I mean, that has been something to behold, to watch what you're doing with this stuff and how you ramp that up.
Thank you. And I'll tell you the most interesting thing. When we bought the rights in 2021 from the sports leagues and the players' associations, they all thought we were nuts. We went and said...
I did too.
Right. Because we're walking and saying, look, you're at an all-time COVID high.
Yeah.
Collectibles has never been bigger, and we're going to walk in and guarantee you 100% of what you make.
Yeah.
We're going to give you a higher royalty rate. We're going to let you participate in all the secondary markets that you don't participate in today. And then, by the way, we're actually going to start to market this category for the first time.
But it was also based, if I believe, and maybe just the world changed, a little bit on digital cards. Remember, there was because there was this whole NFT craze, everyone thought maybe that was where this was all going to head. And most of this has been physical for you.
It's all physical. We did get in and out of the NFT business very quickly. It was about 4 months. We raised $100 million and then gave the money back to investors. Probably we have the only investors that didn't lose money in the NFT business. But my point was, when I think about whether we should go public or not, what I'm thinking about right now is how do we build the best company?
So, but when's the time to go public? Once you're profitable? Once you're going to be... When do you need the money and why?
Well, we don't need the money. Yeah, we have a good balance sheet. The company has no liquidity needs.
But at some point, you're going to probably want to wait for employees and others.
Yeah, I think the most important thing about, long term, I think you want to give your investors and your employees liquidity. But right now, we think about all our business, we're growing so quickly. This year, we thought it'd be approaching $9 billion. Will be substantially over $9 billion. Next year will be over $12 billion. And so for us, we're just thinking about how do we build the best business. There's so much growth in collectibles, so much growth in gaming, there's so much growth in our core commerce business. And then you think those three businesses alone I'll tell you our plan. We think we can do over $5 billion in profits in 2030 in just the three businesses we're in. We have a couple other businesses we're launching.
I know we got to go, but I got one final question for you. Everybody's talking about how we are in this like sports. I don't know if it's a bubble or what's going on, but everybody's interested in the business of sports now, right? That is like
no question.
The thing. Everyone's buying into different leagues, and I'm not talking just about the NFL and the NBA and MLB. I'm talking about paddle and sailing and drone racing and all of this stuff. And so the question is how you actually see this whole space play out. Also, because the media rights have become a huge component part of this. And again, even beyond sort of the majors.
Or any of those pets.com. I mean, it feels like an internet bubble. So I don't want some of those. I guarantee I've never watched.
I think, obviously, in the overall sports ecosystem, I think there's going to continue to be significant appreciation. That's why every day that goes by, people are trying to do more and more with Fanatics. I think you're talking about sports team ownership. Look, there's only 32 NFL teams. There's only 30 baseball teams. So when you look at the scarcity and you look at the amount of money in this world, there's so many people chasing, this small amount of teams. The same thing with Fanatics. Look, we think we can be the most valuable company in sport in the next 5 years.
But to Andrew's point, WNBA is one thing to see that as a huge growth market. It's another thing when you get to, I have found myself watching competitive pillow fighting for about 5 minutes. I
haven't watched competitive pillow fighting yet.
Done a certain way.
Is that
not the way you think?
Is that at your house with your husband and kids, or is that like?
Yeah, I was laughing with them. I was laughing with them. Like,
no,
this is hilarious.
It was a competitive pillow fighting at your house.
Oh, no. It's on YouTube.
Would you watch pickleball?
So let me look, I think in general, if you look, I don't understand AI the way you guys probably do and most people do today, but I will tell you.
Do.
Here's what I'd say to you. I think there will be a lot of winners, but there'll probably be more losers in that space as the market really just continues to develop. In sports, I think there's going to be a very high percentage of winners. So I think if you invest in sports teams, if you invest in sports companies, if you're a partner in Fanatics, I think you're going to be very fortunate because I think the momentum in sports is very clear, and I think there's a ton of wind behind our back. And so I think overall, will certain things fail? Of course.
Do you ever miss owning a team outright?
Not in the slightest. There's
nothing I can't
believe
that. You're such a fan.
Miss.
How do you not miss
Because
that?
for me, there's so much fun about trying to build one of the most interesting consumer brands in the world. If I sit here today saying just the three businesses that we're in, we think can make more than $5 billion in profit.
Are you still
have your seats? You still have your seats?
I feel bad saying this. I think I went to 2 Sixers games last year. The second I sold my ownership, I never looked back.
Because you're a businessman first and foremost.
Were you up in the rafters? You were not up in the rafters.
Let me say this. I think it really became a conflict, and I want to build our betting business and build our collectibles business, and we just kept getting bigger and bigger. It was too complicated.
You are a monster businessman. I give you that. I can't believe that overtook your sports.
It's the one thing. It's the one thing I'm actually pretty decent at, and I love it, and it's so fun. And I wake up
game.
It's my game. I get to play it every day, and there's a great thing. I say this all the time to some of my friends are some of the best athletes in the world. I am so lucky that until I die, I can do this from when I wake up until I go to bed every day and get to play a great game. And that's something that I'm so fortunate for. And so
as you laugh at them, like your days are numbered.
Well,
sports guys.
It's funny. You see certain people who can make an incredible transition and other people that can't. But I think it's very difficult to go from being one of the best athletes in the world to, hey, what am I going to do next? Now, some people make that transition incredibly well. Like I look at the drive Tom Brady has, and like the same intensity that
Steph Curry
got him to win 7 Super Bowls is why he's so successful in business. But I know I'm going to play this game for the rest of my life. And for me, I remember when I watched the Nike movie Air 2 years ago.
Yeah.
And as soon as it got done, I looked at Camille. I'm like, how old do you think Phil Knight is now? And I went and Googled. I'm like, he was 85 2 years ago.
Yeah.
I'm 51. Like, think what I can do over the next 30 years. Like, what we can build Fanatics into.
Second half of your life should be better than the first half.
And we're just getting started with Fanatics. People say, "Oh, you're running a big company." We're not. Like, we're only, whatever, $12.5, $13 billion next year, 22,000 people. We're just getting started. And so we have these 3 incredible businesses and so much to grow with them.
I think it would be easier for you to win at business than to win an NBA title.
Well, by the way, it definitely is easier because winning an NBA title is really hard, and we never did it. And it's one of the things that really frustrated me is that we gave it everything we had.
I think he means you.
Right. No, I mean
he
him.
meant the Sixers.
No, I think he means you winning it.
No, the reason that Fanatics the betting site is not profitable is because I'm cleaning up. day in and day out. And when your margins are going to be squeezed.
Look,
you asked me to join. You wanted me to.
And we're terrified of having a business, but
that's what I mean.
We're going to back down.
You better be.
We need you and everybody else who's watching this show.
Michael Rubin, thank you. Thank you for coming on the show.
$18.
As long as you have.
$18 the other night.
Congrats.
We love
on 30
following
years.
your progress. So thank you.
Appreciate being here.
Appreciate it.
Great to see you.
And that is Squawk Pod for today. Thanks for listening. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern to get the smartest takes and analysis from our TV show right into your ears. Please follow Squawk Pod wherever you get your podcasts. We'll meet you right back here tomorrow.
We are clear. Thanks, guys.